Alright, we've reached our last chapter in lesson 1. So in this chapter, which is chapter 5, we'll be going through market inefficiency. So without wasting any time, let's get right into it. What is inefficiency? Right? Inefficiency in simple terms is imbalance, and then efficiency in simple terms is balanced, right? So when we look at inefficient price action, we notice that wicks don't meet. This therefore means this move had a lot of buying or selling power, which has created that imbalance, right? So when looking at efficient price action, we notice that all wicks meet, right? It essentially means that when price is moving over to the upside or the downside, both buyers and sellers have a fair chance at access to liquidity. So now let's go through this textbook example, right? So right here we have inefficiency, which is imbalance, right? So we can identify that this wick right here doesn't meet with that wick. So that's why we say that it's imbalance. So we have imbalance in between, right? And then let's look at efficiency. Efficiency, wicks meet, right? So this wick right of this candlestick meets with this wick of that candlestick right there. So basically when you spot inefficient price action, you must keep in mind that price comes back to fill in that imbalance to prove that both buyers and sellers have a fair chance at liquidating the market. But however, this does not mean that every imbalance is filled. Alright, so this is the part of the video where we go through live chart examples, right? So I will start with the bearish example, and then I'll then proceed with the bullish example. So as we can already identify this order block, this wick right here does not meet with this wick right here, right? So the market has left that imbalance, right? And then we know when the market leaves an imbalance, it has to come back and fill in that imbalance, right? So the market dropped right here, and then the market came back to fill in what? This imbalance that was left behind. So now let's proceed to our bullish example. So as we can already identify here, we have our order block, right? We take our week, right, week to week, to see if that there's any imbalance. So we can already identify an imbalance right here. So when we take it to the side, the market has to come back and fill it in. So the market did exactly that, came and mitigated our order block and then shoot it up, right? So that's how market inefficiency work. Alright, let's quickly go through efficient price action, right? For efficient price action, you will notice on the chart that the market has balanced price. Like for example here, wicks met, right? Both buyers and sellers had a chance in liquidity, right? As we can already see, we don't have any clear imbalance, right? And the market keeps on balancing price, keeps on balancing price. That's where we say that both buyers and sellers have a fair chance in liquidity, right?